You want a new car. You go to the dealership, you sit down with the finance manager, and they ask you one question that decides almost everything that happens next. What monthly payment are you comfortable with? Not what car do you want, not what's your budget for the total purchase, just the monthly number. You say something like $500, they disappear for a few minutes, and they come back with a deal that hits exactly $500. Problem solved. You drive home happy. Here's the thing nobody tells you in that room. The monthly payment is the easiest number in the entire transaction to manipulate. And once you understand how it's manipulated, you start to see the 84-month loan for what it actually is. It isn't a financing option. It's a pressure release valve for a price that's already too high. And pulling that valve creates a problem that's much harder to see than the one it solves.
Let's start with the plain mechanics, because the loan itself is simple math wrapped around a psychological trick. A monthly payment is just 3 inputs: the amount borrowed, the interest rate, and the number of months, rearranged so that any one of them can be adjusted to make the other 2 look smaller. If a car costs more than you can comfortably afford at 60 months, a dealer doesn't need to lower the price. They just stretch the term. The car that didn't fit your budget at $47,000 over 5 years suddenly fits at 7. Nothing about the price changed. Nothing about your income changed. What changed is that the pain got spread thinner and pushed further into the future. And that's precisely why this kind of loan has moved from a rare option to a mainstream one. A decade ago, roughly 1 in 10 new car buyers signed up for a loan of 84 months or longer. By the first quarter of 2026, that share had climbed to about 23%, and the average amount financed for a new vehicle had reached nearly $44,000, an asset that starts losing value the moment it's driven off the lot.
That last part is the piece that makes this whole arrangement so dangerous, and it's worth slowing down on, because it's the one variable most buyers never actually see: the shape of a car's depreciation curve versus the shape of a loan's payoff curve. A new car typically loses somewhere around 20% of its value in the first year alone, and by year 5, it's often worth less than half of what it sold for. That curve is steep at the start and flattens out over time. A loan works the opposite way. In the early months of any amortizing loan, most of each payment goes toward interest, not principal, which means the balance you owe shrinks slowly at first and picks up speed only in the later years. Draw those 2 curves on the same chart and you get a gap in the middle. A stretch of time where what you owe is higher than what the car is worth. Every loan has some version of this gap. What an 84-month term does is widen it and extend it, because a car depreciating on its natural 5 to 6 year curve is now being financed on a 7-year schedule. The car finishes losing most of its value long before you finish paying for it.
That gap has a name in the industry: negative equity, or being underwater, and it used to be a relatively contained problem. It isn't anymore. By the fourth quarter of 2025, the average amount owed on underwater trade-ins had reached an all-time high of about $7,214, and 27% of these trade-ins carry $10,000 or more in negative equity, itself a record. Roughly 30% of borrowers who traded in a vehicle in the first quarter of 2026 carried negative equity, with an average shortfall of about $7,200. A 42% jump compared to the same period 5 years earlier. Here's the question that actually matters, though. What happens to that leftover debt? It doesn't disappear when you trade the car in. Dealers simply roll it into the new loan. So the buyer who was underwater on car 1 drives off the lot having financed the sticker price of car 2, plus the debt from car 1. And that combined number is now bigger than either car was ever worth on its own. This is where the 84-month term stops being a convenience and starts being a mechanism, because it's specifically the kind of loan long enough to absorb that rolled over debt without wrecking the monthly payment. In the first quarter of 2026, 43% of new loans involving trade-ins with negative equity extended to 84 months, and the average term on these rollover loans reached 77.4 months, compared with 70.3 months for loans overall. The longer term isn't just correlated with negative equity, it's frequently the tool being used to hide it.
And it comes at a price the monthly payment was specifically designed to obscure. Customers taking 84-month loans currently pay an average interest rate of about 8.53%, which is roughly 1.3 percentage points higher than the average rate on 72-month loans, and about 3.6 points higher than on 60-month loans. Longer terms aren't just longer,
They're more expensive per dollar borrowed, on top of applying that higher rate across more months. Run the numbers on a fairly ordinary $40,000 loan, and the gap becomes concrete. Stretching from 60 to 72 months adds about $1,524 in total interest, and stretching all the way to 84 months adds $2,952. And that's before accounting for the fact that 84-month borrowers are typically charged the higher rate to begin with. Widen the loan amount to something closer to today's averages, and the interest gap widens with it. Financing roughly $44,000 for 84 months at a rate available to a borrower with fair to poor credit produces a monthly payment around $803, a number that looks perfectly manageable sitting on a page. What that same page doesn't show you as clearly is the total interest paid over those 7 years, quietly accumulating in the background, while the payment itself stays flat and unthreatening.
So who is actually taking these loans? And why does the industry keep offering them if the math is this lopsided? This is where it stops being a story about irresponsible borrowers and starts being a story about a market adjusting to a price problem it can't otherwise solve. The share of new car buyers earning less than $100,000 a year fell from 50% in 2020 to 37% last year, according to Cox Automotive. Meaning the pool of buyers who can comfortably afford new cars on traditional terms has been shrinking, even as vehicle prices keep climbing. One industry analyst described the trend toward 84-month plus financing as reflective of a market that favors large, expensive vehicles. In other words, rather than the market correcting toward more affordable cars, it has been correcting toward longer loans on the same expensive ones. From the lender's side, this is not a reluctant accommodation. A longer term at a higher rate generates more total interest revenue per loan, and stretching affordability keeps units moving off dealer lots that would otherwise sit unsold at prices buyers can't stomach on a 5-year term. Everyone at the table has a reason to prefer the long loan, except the person actually signing it.
There's a second collision buried in this structure that almost never gets mentioned, and it's arguably the more consequential one: the mismatch between when a loan ends and when a car actually starts needing serious money spent on it. Longer terms leave buyers making payments well into years 7 and 8, precisely the point when major repairs typically begin. A car financed on a 5-year loan is usually paid off with a few years of low-maintenance driving still ahead of it. A car financed on a 7-year loan is often still being paid for at the exact moment its transmission, suspension, or major electrical components start failing. The buyer isn't just carrying a longer debt. They're carrying that debt straight through the most expensive years of ownership, with no equity cushion and often no cash reserve, because the whole point of the long loan was to free up monthly cash flow, not to build savings.
Now, stack a third layer on top of the first two, because this is where the quiet arithmetic becomes an actual crisis for a meaningful share of borrowers. Consumers who rolled over negative equity from a prior vehicle loan were more than twice as likely to have their car repossessed within 2 years, compared with those who netted money on a trade-in, according to a 2024 study from the Consumer Financial Protection Bureau. Think about why that makes structural sense, rather than just being a correlation. A borrower who rolls negative equity into a new 84-month loan is, almost by definition, someone who was already financially stretched on the previous vehicle. Extending the loan doesn't fix that underlying strain. It just delays when the strain becomes visible, while simultaneously increasing the total amount owed. A single missed paycheck, a job loss, or an unexpected repair bill lands on a borrower who has less equity, less monthly slack, and more total debt than they would have had on a shorter term. The loan that was sold as the solution to affordability becomes the mechanism that makes default more likely down the road.
This is also, not coincidentally, the moment where the industry itself started sounding nervous about its own product. Lenders have kept payments in range by extending loan terms towards 72 to 84 months, but this leads to more time spent in negative equity and greater risk as used vehicle prices normalize. Analysts covering the auto finance industry have flagged that as used prices soften from their pandemic-era highs, the recovery value lenders can expect on a repossessed vehicle shrinks too, meaning the loss on a defaulted loan gets bigger
even as the number of defaults holds steady. A portfolio can look stable on delinquency and still quietly underperform on the size of the losses when it does happen. In plain terms, the industry built a product that made loans easier to originate and harder to safely unwind, and it's now watching that trade-off show up on its own balance sheets.
So, does any of this mean the 84-month loan is simply a mistake, full stop? Not quite. And this is worth being honest about, because the picture isn't purely one-sided. For a buyer who genuinely needs a specific vehicle, plans to keep it well past the loan term, and would otherwise be forced into a much higher rate loan or no loan at all, a longer term at a lower payment can be the more stable choice than overextending on a shorter one. The problem was never the length of the loan in isolation. It's the length of the loan combined with rolled over debt, a car purchased at the edge of affordability rather than comfortably within it, and no plan for what happens when the depreciation curve and the payoff curve cross in the wrong direction. The loan is a tool. Whether it traps you depends entirely on what it's being used to paper over.
Which brings this back to that finance manager's question at the very beginning. What monthly payment are you comfortable with? It sounds like the responsible question to ask. It's actually the question that hides the two numbers that matter more: how much you're really borrowing, and how long you'll be carrying an asset that's worth less than what you owe on it. The monthly payment was never the price of the car. It was always just the price of not looking at the total, stretched out until it stopped hurting to see. And that's the quiet mechanism sitting underneath the entire affordability conversation in the auto industry right now. Not that cars got a little more expensive, but that an entire financing system evolved to make that expense invisible, one more month at a time.